People are afraid of debts, even you. You don't want to be in debt with someone unless it's needed, right? How about we can make debt as positive one? How about we can be rich while in debt? It's pretty hard to comprehend, I know. How can someone be rich when he's full of debt? Hilarious. For today's video, let's talk about how we can make money with debt. Hi, welcome to Cash Baggy. In this channel, we talk about income opportunities such as side hustles, online income streams, and financial security. All in all, let's talk about money. Many individuals are afraid of the word debt. There are numerous books, magazines, and television programs that focus on teaching viewers how to manage their debt. While taking on debt may seem like a bad idea, if done right, it can actually have a positive effects. Leveraging debt to enhance your earnings exponentially is the main way to use debt for investing well. What precisely is leverage? Leverage is the process of increasing your return on investment by leveraging borrowed money. With leverage, you can generate returns you previously considered unattainable, but with a higher risk of capital loss. Contrary to popular belief, the wealthy really borrow money quite regularly. The distinction is in the purpose of the borrowing. Basically, if borrowing money opens up a chance, it is totally reasonable. Here are 5 ways to make money with debt. Number 1. Buying real estate. When you buy real estate, you may leverage your money by a factor of 20 with 5% down payments or a part of 1,000 with monthly payments. A real estate investor can purchase a $200,000 home for a down payment of $10,000 and make monthly payments of $2,000 on it. Real estate investors receive returns on the entire loan amount, not just the amount invested. The $10,000 down payment generates a 300% return when combined with the $40,000 investment return if the real estate increases in value from $200,000 to $240,000. Additionally, houses or other assets that generate cash flow might be purchased with debt to use them as Airbnb listings and generate monthly income. The cash flow returns are based on the total amount of debt, not on the capital invested in the asset that generated the returns. Number 2. Short selling. Selling anything short involves selling something that is not yours. When you sell a stock short, you borrow it from your broker and then sell it to a buyer. The shares are then your responsibility to pay to the broker. Even though you gain money from the sale, you must spend it to acquire shares later to reimburse your broker for the share loan. On a short side trade, you are long cash and short the shares. You have borrowed money from your margin account to pay for shares. Your broker can return the shares to the account they were borrowed from once you buy to cover the short position, which will be your debit purchase price to repurchase the shares you were short on the open market. Today, everything is done electronically and is digitized and mechanized. A short seller reverses the trading order. They sell first and then purchase back later. Using debt, you can make money if you sell something short for more than you subsequently pay to repurchase it. You must pay margin interest on the position size while shorting a stock. Additionally, you will be responsible for paying any dividends that are owed on the stock for the duration of your short sale. This is how traders can profit from the stock market's ups and downs. Number 3. Starting a business. I don't want to sound repetitive, but many people can make more money from a business than they can borrow. When starting a business, you will really need capital for things to work out. Starting a business can be a little riskier than the other chances on our list. but the potential returns could be considerably greater. Starting a business is a legitimate reason to consider borrowing money, as long as you know what you are getting into and don't borrow more than you could conceivably afford to lose if things don't work out. What do you think about these points so far? Please share them in the comment section below. And hey, if you are still new to our channel and love our topics, please consider subscribing so that you will be notified anytime we upload a new video. Also, give it a thumbs up as this will allow YouTube to show this video to more people. Thanks! And now, let's continue. Number 4. Hedge funds. Some of the biggest consumers of leverage are hedge funds. They are renowned for using leverage to produce abnormal results. Many hedge funds use the leverage that might reach 10 times their total assets. How do hedge funds profit from borrowing money? Let's say you predict that a particular stock will fail, like Facebook, because you know that the most popular smartphone manufacturer, Apple, will announce next week that it will no longer allow apps to track you, like Facebook or Instagram, and will instead put privacy first, which will seriously harm Facebook's business model. So, you pick up the phone and dial your broker to borrow from him a single share of Facebook stock that costs, say, $100 and sell it right away for $100 on the open market. Congratulations, you now have $100 in your pocket, but your broker still needs to be paid for one share of Facebook. Let's say you are correct, and the Facebook stock price drops to $78 the following week. You would use that $100 to purchase one Facebook stock at a lower price, return it to your broker, and keep the difference. Congratulations on making 30 from a complete stock. Though it appears simple in theory, doing it well is quite risky and complicated. What happens if you are mistaken? Let's say the cost increases by 50% overnight. Your prediction is false and you will lose your money. You still have to pay interest for borrowing that one share of Facebook stock and return it to your broker. A hedge fund could go out of business and lose all investors' money if the fund manager's investment prediction is incorrect. Number 5. Margin investing. In a margin account, which is a specific kind of brokerage account, the stockbroker lends the investor money or shares while using the investor's account as collateral to buy securities. By using margin trading, your broker can boost the amount and number of deals you can execute by adding purchasing power to your account. You can utilize margin to give your trades more leverage or to flip them over more quickly, so you don't have to wait for them to clear when you enter or exit a trade, or increased if you employ margin to make your trades larger. Your winnings are twice as big if you trade twice as big of a position as you would have done without margin. But your losses are also twice as significant if you sell at twice the size. If the stocks they purchase can be used for total leverage, traders and investors using margin accounts can typically increase the size of their total trade position. More importantly, margin enables day traders to maintain buying power without waiting for all of their trades to clear. For instance, you might open a margin account and leverage your investment if you have $50,000 in your standard brokerage account. Up to 50% of the stock's purchase price might be put down on a margin account. An additional $50,000 would be lent to you by your broker, and you would already have $50,000 in cash. You can now buy with the $50,000 you invested, equivalent to $100,000. This cash might be used to purchase stock worth $100,000. In summary, wealthy people excel at utilizing credit to their benefit. They search for chances to make a profit from the difference between their returns and the interest rate they can borrow money at. That's frequently how they initially became wealthy. Borrowing money requires courage and talent to manage your finances. Other people can't handle this type of pressure. That's why they fail. And in the end, they are in massive amounts of debt. You must be really careful with your decisions, especially in handling money that is not yours in the first place. What do you think about this topic? Do you agree with us too? Do you want to be a TikTok content creator? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe, and we'll see you in the next video.